Of course cash is still trash. Cash, I'm asking you, you know how fast you're losing buying power in cash?
I feel that.
Equities are trashier.
Ray Dalio, one of the greatest investors of all time, also the founder of Bridgewater, the largest hedge fund in the world, managing over $235 billion, thinks that cash is trash, and U.S. stocks are even trashier, where U.S. stocks are potentially facing a lost decade. What? How is that possible? Okay, let's take a second, rewind, go back to his comments on why cash is trash. It's March 2020. The U.S. is facing COVID lockdowns, and the economy is looking at a record 30% contraction. So what does the U.S. government do? You're looking at huge stimulus by Congress and radical money printing by the Federal Reserve. So the U.S. government intervened with fiscal policy, this was deficit spending, and monetary policy, money printing and lowering interest rates to keep the economy afloat. This was the right policy at the time, but they took it a little too far. Even after the economy stabilized following the initial shock of the pandemic, the Federal Reserve continued to print trillions of dollars in new cash to stimulate the economy. From February 2020 through March 2022, the Federal Reserve created nearly $5 trillion in new cash. With a huge increase of cash in the system and a little change in the end supply of goods and services, you start to see real inflation, or as Ray Dalio describes it.
When the amount of spending and incomes grow faster than the production of goods, prices rise. When prices rise, we call this inflation.
While a little inflation is tolerable, a lot of inflation, like what we're currently experiencing, can lead to huge problems like societal unrest as people start having real trouble paying for basic necessities like food, energy, and housing. It's also why Ray Dalio thinks that cash is trash. The more inflation you have, the less purchasing power you have. The higher the inflation, the more your buying power is reduced. Charlie Munger, Warren Buffett's investment partner, had this to say about the impact of inflation long term.
Well, I think the safe assumption for an investor is that over the next 100 years, the currency is going to zero.
This makes sense because if you have 5% annualized inflation, let's say over 40 years, you will lose nearly 90% of your purchasing power. Similarly, 5% annual inflation over 80 years and you will lose over 98% of your original purchasing power. So if cash is trash, should you buy stocks?
Equities are trashier.
Okay, so why are stocks trashier? Once again, you need to understand what the Federal Reserve is doing. The Federal Reserve will raise interest rates and start pulling cash or liquidity out of the system in order to combat inflation. Higher rates ultimately hurt the economy. This is because there are fewer borrowers that can afford to take on new loans, and the cost of servicing existing debt also goes up. So this is a very tricky dance for the Federal Reserve as they look to manage inflation along with not crashing the U.S. economy. So why is higher rates and higher inflation bad for stocks? It comes down to four key reasons. The first reason is because high inflation often means higher input costs or higher expenses. This means companies' profit margins have a tendency to surprise lower. With lower earnings comes lower stock prices. The second reason is because of liquidity. Ray Dalio's Bridgewater estimates that nearly 40% of U.S. stocks require new buyers to emerge just to keep their businesses going. This is a critical difference between companies that have tremendous free cash flow or are self-financing and those that are cash burning. Cash burning companies are in real trouble as the Federal Reserve pulls capital out of the system. Arguably, this is why you've seen many growth stocks fall and come under such significant pressure. Many of these companies will ultimately go bankrupt or get acquired at a discount. A third key risk is valuation compression. As interest rates move higher to combat inflation, cash becomes less trashy and new stock investors demand getting paid in return for higher interest rates. If Treasury bonds, let's say, yield 4 or 5%, stocks need to promise a much, much better return in order to justify the risk that's getting considered, the extra risk of owning stocks. This is increasingly hard to do when you factor in this last key risk. The last key risk is recession. Just like how the Federal Reserve overshot on stimulating the economy in response to COVID, that resulted in inflation, it's also possible that they overshoot on combating inflation and the economy falls into a deep recession. When you factor all these risks together and consider that the Federal Reserve has its hands tied because of high inflation, this can lead to what Bridgewater suspects could be a lost decade. So how can you invest right now? First, I'm going to share my personal take, and then I'll share what Bridgewater has disclosed on how they're managing to invest in this challenging time. Personally, I prefer to focus on unrivaled companies at fair prices, hence the name of this channel, Unrivaled Investing. If the company is a cash cow generating lots of profits, then I want to pay a fair multiple to free cash flow. But if the company is not yet at scale and is still burning lots of cash, and they might need to go through some of their balance sheet or even tap investors in the future, then I want to pay a really, really discounted value to get tremendous upside potential over time. Now, I call out this range of possible companies, both the cash cows as well as these hyper-growth unprofitable businesses, to my Unrivaled Investing subscribers on a monthly basis. I also share my own personal investment journey for those interested. Also, a big shout out to all the Unrivaled Investing subscribers, because they're the ones that keep this channel and these educational videos going. So how is Bridgewater investing in this challenging climate? First, they own more commodities. No matter how much money printing there is, you can't print more commodities like oil and copper. Second, they own foreign stocks. Bridgewater estimates that many foreign markets are between 30 to 40% cheaper than the US. This is particularly challenging, however, as each market has its own problems. For example, Europe now faces an energy crisis and a sharp recession. If you consider China, it has immense rule of law risks and is already facing an economic downturn. That said, they're now seeing monetary easing, and their valuations are dirt cheap relative to many U.S. equities. The third way Bridgewater has called out that they're investing in this period is to own inflation-sensitive assets. I suspect these are complex derivative positions where they might short long-dated U.S. Treasuries and invest the proceeds into Treasury inflation-protected securities, or investing in TIPS, whose principal increases with inflation. If you enjoyed this video on Ray Dalio's take, why cash is trash and how stocks are even trashier, ways to invest in this challenging environment, please make a point of hitting that thumbs up and hit that subscribe button. Thank you so much for tuning in.